Hey everyone, welcome back to Corporate Decoder. Today, HNRG just filed a current report and I am seeing a slight tweak that might matter for lenders. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing highlights a change to how Hallador Energy Company calculates a key financial metric, which could impact their borrowing power. So what we have here is a Form 8K filing from Hallador Energy Company, which is essentially a report of major corporate events that shareholders need to know about. The date of this report is the 11th of August 2026, and it tells us about a significant event that happened on that same day. The company, Hallador Energy Company, also known by its ticker symbol HNRG, is an independent power producer. You might know them from their operations in the energy sector. Recently, they've been in the news for things like their stock rating being lowered, but also for potential capacity increases coming. The main event reported here is the company entering into a third amendment to a credit agreement. Think of a credit agreement like a loan contract. This third amendment means they are changing the terms of an existing loan with Texas Capital Bank, which is acting as the administrative agent for the lenders. This agreement was originally put in place back in March of 2026. And it has been amended twice before this. Now, why is this amendment important? It specifically modifies the definition of EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a way to measure a company's operating performance without getting bogged down by financing decisions, accounting choices, or tax environments. It is a commonly used metric, especially for assessing a company's ability to generate cash from its core business. What this amendment does is allow Hallador Energy to add back up to $10 million in payments received for exclusivity agreements related to power purchase contracts. This is specifically for the quarter that ended on the 30th of June 2026. By adding these payments back into their EBITDA calculation, their reported EBITDA number will look higher. Now, this might sound like just a small accounting change, but it has real-world consequences. For companies that have loan agreements tied to financial covenants, like maintaining a certain EBITDA level, this tweak can be significant. It can help them stay in compliance with their loan terms, especially if their core operations are under pressure. Given that one recent headline mentioned Hallador Energy facing a margin squeeze, this amendment could be a way to manage their debt obligations more effectively without having to immediately raise more capital or cut costs drastically. The actual amendment document labeled Exhibit 10.1 is attached to this filing and provides all the legal details. While we are not going to dive into the legalese here, the key takeaway is this change to EBITDA. This filing also falls under item 2.03, which covers the creation of direct financial obligations. By amending their credit agreement, Hallador Energy is essentially reaffirming and adjusting its financial commitments. Looking at the company's public profile, Hallador Energy Company's common shares trade on the Nasdaq under the symbol HNRG. They have a market capitalization of around $762 million, with a current price of about $16.16. This stock has seen some fluctuations lately, with a recent headline noting a 4.3% surge in shares. While another pointed to margin squeeze issues, the report is signed by Eric van der Maan, the Chief Accounting Officer. This indicates the financial nature of the filing and that it has been reviewed by the company's top accounting executive. So, what does this all mean for Hallador Energy? This amendment to the credit agreement, specifically the adjustment to EBITDA, is a move to provide the company with a bit more financial flexibility, especially concerning its debt. It allows them to potentially show a stronger financial picture to their lenders by including certain time payments. This is not uncommon for companies, especially in cyclical industries like energy, where earnings can be volatile. When a company is facing challenges, as some headlines suggest Hallador Energy might be, these kinds of adjustments to financial covenants can be crucial for avoiding default. However, it is also important to remember what this amendment does not do. It does not change the underlying business operations or necessarily mean the company is suddenly more profitable in its core day-to-day activities. It is a financial engineering tool that makes it easier to meet loan requirements. Looking at the broader context, Hallador Energy has a market cap of $762 million and a PCE ratio of 808.0, which is quite high, suggesting investors have high expectations for future growth, or that earnings are currently very low. Their stock prices range between $13.65 and $24.7 over the past year. With 633 employees, it's a significant operation. The top institutional holders are significant, with Lubar and Company holding over 11% of the shares, and BlackRock with over 6%. These large holders likely keep a close eye on such financial maneuvers. In essence, This filing tells us Hallador Energy is proactively managing its debt agreements. While it might ease concerns for lenders in the short term, it doesn't resolve any underlying operational pressures. The company's ability to generate consistent, strong operating cash flow will ultimately determine its long-term success. This amendment is a strategic move to buy some time and maintain compliance while they navigate any business headwinds. The risk I am watching is whether these adjustments are a temporary fix or if they mask deeper issues in the company's core profitability. What I'm actually looking for is sustained improvement in operational earnings that does not rely on financial covenant adjustments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like this video and subscribe for more. Join our Discord community, linked in the description.